Welcome to Talk Tickers, where we break down the most pivotal earnings calls. Today, we're digging into a real head-scratcher, Domo's Q3 earnings report. On the surface, the numbers looked pretty good, so why on earth did the stock get hammered, dropping 24% overnight? Let's get into what happened on their December 4th call.
So what we have here is a classic tale of two tapes. You've got the story the company was telling, which sounded pretty positive, and then you have the market's reaction, which was, well, it was swift and it was absolutely brutal. They were just not on the same page.
All right, check this out. Domo actually reported a profit on a non-GAAP basis when Wall Street was expecting them to post a loss. That's a solid beat. You'd think that's great news, right? Well, the very next day, the stock got a 24% haircut. It just collapsed.
So that's the big question, isn't it? Why the massive disconnect? To really get it, you have to understand the two competing narratives that were battling it out on that earnings call. You've got the story management was trying to sell, and then you've got the story the market actually heard.
Okay, first, let's put on our optimist hat and look at this from management's perspective. They laid out their case and they pointed to some real operational wins that, they believe show the company is getting fundamentally stronger, even if there are some headwinds out there. And the big number they were hanging their hat on was this, 6.8%. That was their non-GAAP operating margin, a company record. To management, this was the, see, we're doing it moment. It was their proof that they have a handle on costs and can run the business with real discipline. And that discipline, it's flowing right down to the cash register. We're talking about a nearly $16 million improvement in adjusted free cash flow compared to this time last year. Now, this is a big deal because it actually puts Domo on track to be free cash flow positive for the first time ever in a full year. That's a huge milestone for any company. Management was also quick to highlight that their big strategic moves are starting to pay off. 80% of their recurring revenue is now tied to these consumption-based contracts, and their Cloud Amplifier product is just taking off. User growth is up a whopping 450%. But here's the kicker. Customers on this new model are sticking around and spending more. That 106% net retention rate tells you the strategy has some real legs.
Okay, but here's the thing. The market, well, it wasn't buying the victory lap. Not at all. Experienced investors basically looked right past those positive numbers and zoomed in on three big, flashing warning signs that pointed to a much tougher road ahead.
First and foremost, the elephant in the room, growth has just stopped. It's completely stalled out. Revenue was basically flat to slightly down. But the real killer, the number that sent shivers down Wall Street's spine, was billings. Think of billings as your crystal ball for future revenue, and that number came in at 0, flat. For a software company that's valued on its growth potential, that is a 5-alarm fire.
And if that wasn't bad enough, the second problem was the guidance. Management's forecast for the next quarter? A total miss. It came in below what analysts were expecting on both revenue and earnings. So this basically told the market, hey, that weakness you saw in Q3, get used to it. This isn't a blip, it's the new trend. And then the third shoe dropped. A real curveball. The founder and CEO, Josh James, announced he was taking a step back for a bit to focus on his health. Now, you absolutely wish him the best, of course. But from an investor's point of view, the timing was just awful. It throws this huge cloud of uncertainty over the company's leadership right when its strategy is being seriously questioned.
So you can see the problem, right? You've got management saying, look at our profits, while the market is screaming, but what about growth? So how do we square this? Let's move on to the next call and figure out what the path forward looks like for Domo.
Okay, so if Domo wants to win back the market's trust, they have a very clear 3-step mission. It is not going to be easy, but here it is. Step 1, they have to hit their numbers for Q4. They've lowered the bar, now they need to clear it. Step 2, and this is the big one, prove that their strategy can actually get that billings number growing again. And step 3, show everybody they can manage this leadership transition smoothly without any drama.
All right, prediction time. What should we expect to see next quarter? Honestly, we think they'll probably meet that lowered guidance. Management's at a pretty low bar for themselves, but, and this is a big but, we don't see the stock going anywhere until they can show some real proof that growth is back on the menu. So expect the stock to probably stay stuck in this range until we see that billings number start to tick up. That's the metric to watch.
So when you put it all together, our rating here at Talk Tickers is market perform. Look, the progress they've made on profitability is real, and becoming cash flow positive is a huge achievement.
But you just can't ignore this perfect storm of zero growth, weak guidance, and a big question mark at the top. It completely justifies why the market hit the reset button on the stock's valuation.
And that's our breakdown of Domo's very challenging quarter. As always, remember, this analysis is for informational purposes only, and it is definitely not financial advice.